With rates at 9.62%, these once boring and low-yield bonds have caught the attention of stability-seeking investors. In this video, I will tell you everything about Series I savings bonds, including what they are, their limitations, tax considerations, and ways you can buy them. As a bonus, I will share with you a loophole you can use to increase the yearly limit towards the end of the video. Hi, my name is Neera and I'm a financial analyst. I talk about personal finance and investments and teach you how to make money and grow it exponentially. If you're interested in this topic, consider subscribing, as this will help the channel grow and impact more people. Series I bonds are one of the safest and currently the most appealing investment product. First introduced in 1998, Series I bond offers an inflation protection savings bonds and are 100% backed by the US government. Therefore, they are considered low risk. This is the closest to a risk-free investment you can get. It doesn't even have inflation risk since the returns grow with inflation. Let's look at the announcement by the then Vice President Al Gore.
So today I'm very pleased to announce that for the very first time, families will be able to buy new inflation-protected government bonds. These savings bonds offer true inflation insurance, helping middle-income families save for retirement and invest in their children's education without ever having to worry that their savings might be undercut by future inflation.
The I in the I bond stands for inflation. It pays an interest rate consisting of a fixed rate and an inflation rate. The interest is compounded semi-annually. The fixed rate remains the same for the life of the bond and is determined by the Treasury twice a year, on the first business day in May and on the first business day in November. The inflation rate will change depending on the CPI index, which is a measure used to gauge inflation. This means that the interest rate changes every 6 months depending on the inflation and is also announced twice a year, on the first business day of May and on the first business day of November. However, the new rate does not apply immediately on your bond. In this chart, you can see when the new rate applies to your bond depending on which month you bought it. For example, if you bought a bond in March 2020, you would buy into a rate that was set on November 2019, and you will have the same rate for the next 6 months, which means even if the new rate is set on May 1st, 2020, your bond will keep earning the November 2019 rate until the 1st of September 2020, when the 6 months of your bond will expire, and the May 1st, 2020 rate is applied for the next 6 months, September 2020 through March 2021. Hopefully all the different dates didn't confuse you. Put it in simple terms, for our example of a March 2020 bond, the rates will change for the bond every March 1st and September 1st of every year. I couldn't find any information as to how they set a fixed rate or what influences their decision. If I had to guess, I'd say that the demand for cash in the years of high government spending and low inflation would increase the fixed rate in order to incentivize the population to invest in these bonds. So I would suggest not to max out your contributions in the first half of the year. If we look at the historical fixed rate, there are cases where the fixed rate was 0 in the first half but went up the second half. Therefore, wait until the next announcement is made for some portion of your contributions, and maybe the fixed rate will go over 0. The 10 basis points or 20 basis points might not make a difference at first, but once you add the inflation rate, especially during high inflationary environment that we have today, it will make a substantial difference. For example, if you bought the bond during the period from November 2008 to April 2009, today you would have earned 10.35% instead of 9.62% on those bonds. However, wait for the second half only when the fixed rate is 0. If it is above 0, it may go up or down, but you're losing potential interest with the risk of the rate going back to 0. So you're not gaining much from delaying the bond purchase. Another point worth mentioning is that in a deflationary environment where inflation is actually negative, These bonds provide a floor of 0%, meaning you're not losing any money by investing in them, no matter how bad inflation is. So holding your extra cash in the I bonds doesn't really have any downside as long as you take the limitations into account, which we will cover later in the video. I wanted to spend some time on this chart and explain where the numbers are coming from because it looks a little confusing. It simply includes the return you will receive today depending on when you bought your bond. For instance, in this chart, if you bought the bond between November 2007 to April 2008 with a fixed rate of 0.20% and did not cash it, today you would receive 10.88% on that bond. It is worth noting that you will receive this interest rate for the duration of 6 months and will keep receiving high interest rate as long as inflation remains high. Now, let's discuss the limitations of the Series I bonds. The main limitation of these bonds is the limit on the amount that you can purchase them for. There is a $10,000 limit per year and a $5,000 limit through the federal tax refund. So per year, you can only buy up to $15,000 of the bonds. There is a loophole that you can use to increase that amount that we will mention later in the video, so stay tuned till the end. Less of a loophole and just merely an observation, the 10,000 limit is per social security number. So depending on your household size, you can purchase more than the $10,000 limit. For instance, if you're a family of 3, you can purchase up to 10,000 of I bonds for each family member. You'll have to create a separate account for each social security number you wish to purchase the bonds for. If your child is a minor under age 18, you will need to create an account for them and link it to your account. Next limitation is you can only cash the bond after 12 months. You will not be able to access your funds within the 12-month period under any circumstances. Well, maybe during a federally declared disaster situation, but nothing less than that. So bear that in mind before making any commitments. Another limit is for the next 5 years after the bond's purchase. If you cash it before the 5 years have passed and after the 12 months hold, you lose the last 3 months of interest. However, if you plan it well enough and buy now at high interest rate and decide to cash out, say, in 2 years when the interest rate might fall, you will only have to give up the last 3 months of the interest, that is the lower rate of return. So it all depends on a good planning. Let's now go through tax considerations. These bonds are great for tax purposes since they do not have any state or local taxes. However, you will need to pay federal taxes once you cash them in. The good news is that you can avoid the federal tax as well if you use the funds towards education. So again, it all depends on a good financial planning on your part. Now that you're motivated to buy the bonds, let's look at ways to purchase the I bonds. Currently, you can purchase the I bonds electronically at treasurydirect.gov, which was first introduced in 2002, up to $10,000 a year. And please don't try to put more money in hopes that you will earn interest until they figure the difference out, since we all know government is slow. But the Treasury Department warns that they will issue a refund of the difference and it may take up to 16 weeks to get it, which means you're not earning any interest on that amount, hence losing money. If you want a video with step-by-step instructions on how to purchase Series I bonds, comment down below. Comment down below. A little trivia for you. The US Treasury stopped selling paper bonds at banks and other financial institutions as of January 2012. The only way you can buy paper bonds now is through your federal tax refund up to $5,000. Just mention to your tax preparer that you want to buy Series I bonds using part or all of your refund. If you're using tax software, you should be able to elect to buy the bonds. You can also give I bonds as gifts. If you give it as a gift, it will be counted towards the recipient's limit only once they receive it. Otherwise, it will be just sitting in your gift account earning interest. This is a loophole you can use to increase the $15,000 limit per year. The trick is to buy gifts during high interest earnings and not deliver them to the recipient until the interest rate on Series I bonds are low and the recipient doesn't reach his $10,000 limit that year. The best part is, while they were sitting in your gift account, they have earned interest and reached the 12 months holding limit. So the recipient can cash them in given that it has been 12 months since you purchased the bonds as gifts. The same $10,000 per year limit applies to buying Series I bonds as gifts and an additional $5,000 through your federal tax refund. Some recommendations. If you want to save for a home, Series I bonds are probably a better option because they grow with inflation, whereas other instruments don't. You need to bear in mind the limitations that were mentioned earlier though. If you're planning on buying your house in the next few months, that is not an option for you. Pay attention to the fixed rate as well, not just the inflation rate. Because remember, the inflation rate changes every 6 months. However, the fixed rate stays the same for the life of the bond. So in years when the fixed rate is high, say 50 basis points and above, but the inflation rate is low, thus the overall rate is low, don't get discouraged from buying the I bonds. They will pay off during high inflationary environments. They're great protection during inflation and tough times. In an environment where all the financial instruments are going south due to high inflation, you are getting the safest and probably highest returns. To summarize the information provided, Series I bonds are a great way to preserve the buying power of your hard-earned dollars. They may not make you rich overnight, but you can sleep in peace knowing that your money is safe and growing slowly for whenever you might need it. If you like this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on notification to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and I'll see you next time. Bye. Determined. Given it